We're going to start with Alicia from Bentonville. Here's her question. How much cash should I have on the side beyond the emergency fund? Thinking of sinking funds for car, home, repair, vacations, etc. What's a good rule of thumb so I'm not keeping too much cash, but still have enough liquid assets to make purchases at the right time and before retirement? Great question, Alicia. We appreciate you sending that in. And, the bottom line is there's certainly no rule of thumb that applies to sinking funds. And I guess we should probably start by defining what really traditionally that is. But she's talking about here, John, setting aside, which is a great idea so that you don't have to borrow money.
Yep.
Set aside a lump sum for large purchases above and beyond what you have set aside that is prepared for emergencies.
Yeah, this term sinking fund is actually refers to paying off a bond by a company. They put money back, so when that bond matures, they've got the money to actually do that. And it's kind of the same thing here, except you as you said, Scott, you're planning a purchase, you're wanting to buy something, and you're saying, okay, it cost X number of dollars, let's say $1,000, so I'm going to save $100 a month for 10 months, and then in the 11th month, I'll be able to buy that item, whatever it might be. So having a sinking fund is a great idea, and we love that idea to keep you from borrowing the money and then paying it off, because you're going to do that with interest, and sometimes high interest with a credit card. But as far as the overall line of thinking, here's what I would say. Emergency funds are forever, and sinking funds kind of come and go, because once you buy that item, then you don't need that sinking fund for that item again. Now, you may want to redirect those savings somewhere else, but I think you've got to have this kind of mental accounting mindset, Scott, of having your emergency fund be okay, in this account or kept up on a spreadsheet or however you want to do it. And then separately, you're saving for those various items, because what you don't want to do is you don't want to delude yourself into thinking, oh, I've got my emergency fund covered. And oh, by the way, I'm going to go take $1,000 out of that emergency fund and go buy this thing. Well, all of a sudden it just became not an emergency fund, but a put and take account. I think you have to have both. You have to have the put and take account as far as your goals are concerned and the items that you want to buy, the sinking fund, if you will. And then you have to have your emergency fund that you have in reserve for true emergencies. And then if you have a true emergency, then you redirect your savings to build that emergency fund back up as soon as possible.
That's what I was going to say, because I think it's important to point out that's the difference. Your emergency fund needs to be set at a specific amount. And if you have an emergency and use some of those funds and they are depleted, you have to set your priority to replacing that, right? So what is a good emergency fund? Because that's the step process. We're going to have to determine that before we get into the sinking fund. And it sounds like Alicia has an emergency fund. We don't know how much she has in it, but a good rule of thumb here would be 3 to 6 months of household expenses. What's it going to take to maintain the household if there's no income coming in for 3 to 6 months? And, Dave Ramsey says, you could even go up to a year here. There is some availability here for comfort level.
Yes.
I think that a number like $20,000, let's say, not knowing what this 3 to 6 month lines out, a lot of people will land on that. I want $20,000 in cash because that's going to help me meet my health insurance deductible if I have to, my homeowner's deductible if I have to. I'm going to leverage the insurance company past all of that. I've got enough money to get out of trouble, right, to get out of the emergency I'm in. And then so let's set that aside. Make sure we don't go, if it's $20,000, below $20,000 unless it's an emergency. And then I think it is a good idea, to your point, to have another account. I mean, you could build on that. If you wanted to have it in the same account, you could say, okay, the first 20 is emergency, the next 20 is my sinking fund. But it does help visualize it better if you keep it separate.
Yeah, some people have to do that. Some people are really good with spreadsheets, and they understand, okay, all the money's in one account, but I've got that segregated or divided up on a spreadsheet, and I know exactly what I'm dealing with here. Other people have to have, okay, this is my statement for the emergency fund. This is my statement for my sinking fund, for my put and take account, as I like to call it. But I think the objective is that you have this big wall between the two, and you say, look, I'm not going to use my emergency fund for my future purchases, and I'm not going to use my future purchases for an emergency because I've got that money already earmarked. Now, I think it is very critical, Scott, that you think about the fact that if you do have an emergency, then maybe you ought to hit pause on the saving for those items that you are saving for, and be sure you build that emergency fund back up as soon as possible, because you never know. Sometimes these things come in twos or threes, and you've got to tap into that emergency fund maybe sooner than you would anticipate.
And with regard to those sinking funds, or with the plan to build up some cash for a major purchase, it's important to be specific as possible with not only the amount that you plan to spend, because that's a budgeting tool, right? You say, hey, I'm going to spend $30,000 on this car, and I'm not going to get a car. So when you go shopping for a car, you don't get lured into getting sold on the $40,000 or $50,000 car because you know your goal is 30. That's very helpful from a financial perspective. But from an investment perspective, and we haven't talked about the investment side of this because Alicia's talking about cash, but I think it's very important to be as specific as possible on timeline. If it's a vacation that you're going to take next year, absolutely you need to be building that savings in cash. If it's a dream vacation you're going to plan to take in 10 years or 8 years, I don't know that cash is the best place to do that.
Yeah, emergency funds are really good to be in a bank savings account, so you've got immediate access to it, or even a money market account, which you could write a check on or have ACH'd into your banking account in a fairly short amount of time. And money market mutual funds are paying above 5% these days in terms of interest on a monthly basis. They on an annualized basis, I should say. 5% is around the benchmark of where money market accounts are sitting right now. So it's not just collecting dust over there. It is earning a nice, decent rate of return. However, if you, as you said, Scott, if you're going to take that vacation in 10 years, you might want to get a little bit more adventuresome, maybe not invested in individual stocks or anything of that nature, but maybe a good diversified mutual fund would give you some growth over that 10-year period of time where you're not just plodding along at 5%. You might actually get a little bit of extra help in meeting your goal from investing in a very diverse, safe, widely invested mutual fund that could be a benefit to you down the road. Of course, that does involve some additional risk. You're going to see the fluctuation of that account go up and down, but the fact that you've got that 10-year time horizon before you need to use that money, I think is helpful in that situation.
We're going to branch a little bit away from Alicia's question here to also kind of refer to this in terms of retirement, right? So if you know, when it comes to being as specific as possible, when you're going to retire, you need a plan that involves all these components as well, right? You need some equity exposure for long-term growth, for money you're not going to touch for 15 plus years, but it could be a good idea to begin building excess cash reserves and maybe utilize a money market mutual fund for the money, if you're retiring in a year or two, to begin using that in the early stages of retirement. Because rather than pulling it from your 401k or your IRA, as we're going to talk about in a little bit, which is going to be taxed, you can receive it, the post-tax income, while you're still working, and begin to pile up the cash on the sidelines in a non-retirement account. And we've mentioned these money market funds, John. I think it's important to kind of maybe drill down a little bit on what that is, because people probably heard, hey, they're getting 5% right now. They're very interested in that, right? We know CDs are also in that realm, even on a short-term basis. 3, 6, 12 months, you're seeing interest rates offered higher than 5%. The difference between a CD and a money market mutual fund, the money market funds invest in short-term, high-quality debt or cash equivalents, and are not intended to provide investors with low-risk income, or they are intended to provide investors with low-risk income and stable liquidity, but they are not completely risk-free. So you think of an FDIC-insured CD, it is insured, as its name implies, by the FDIC, and you know you're going to get your money back if you don't exceed the certain limits. imposed there, and you're going to, as long as you leave it in for the term, you're going to get that interest rate. There is some risk with a money market mutual fund. They're not FDIC insured.
Yeah, they're not, and there's really been very, very long history of stability in money market accounts. They strive to maintain a $1 per share net asset value, and I think there may have been one money market account back during the financial crisis that broke the buck, as they used to call it, and dipped for a short period of time below $1 per share. But money market accounts invest in very, very short term, high quality commercial paper, government bonds, and things of that nature that are very, very safe in terms of their risk factor. So there is some risk in a money market account, but you're not likely to see market fluctuation in that account.
Yeah, so you think about the use for it. It is more liquid than a CD because you can get in and out of it with the daily pricing, but the interest rate's also variable. So,
that's right.
So if we do see interest rates go back down in the future, you'll see that interest rate go down as well. We were not talking about money market funds 2 years ago.
That's
Let's
right.
put it that way.
Yeah.